Hello, it's Stefan Angelini here from Angel Advisory. It's the 14th of February. Here's our economic update talking 2022 asset returns, big tech, India's inflation, so emerging markets, high risk debt, and tips to build an income portfolio to finish it with you. Now, our role is to manage people's money for a living, so we need to consume a whole lot of content to figure out what's going on. So why not share it with you? Before we get started, this is just general information. Please don't consider it as personal advice. If you want any personal advice, please go and see a licensed financial advisor. Now, to kick it off, what happened overnight? It was a big night for big tech, in particularly Amazon, Apple, everything like that. Energy was actually down overnight, so it had a pretty big run. But don't forget, in 18 hours is a long time in markets, so things can change and things can happen. So if you want to look at Amazon, for example, they've increased their service fee over the last little while by a fair bit. In 2016, they took a 35% cut of what producers were selling things for. Now they take a 52% cut. So that's where Amazon's revenues are rising dramatically, but maybe it's a necessary evil. In terms of the energy prices, so prices of oil per barrel are still sitting at about $80, but there are expectations that the iron ore price is going to decrease because a lot of, analysts assume that China's demand for iron ore will not be as high as everyone's predicting. Now, getting around in these companies like Amazon, there's been a lot of layoffs that we're seeing, like up to $50,000 of layoffs announced, but the hiring spree that a lot of these companies went through during COVID was huge. So Amazon hired about 750,000 people and I guess are still hiring people. Companies like Google and Microsoft hired more than 50,000 people and have only announced 6,500 of layoffs. So they hired a whole lot of people and now they're just recalibrating. So don't get too scared off by job cuts that are being announced. In terms of asset price returns and asset class returns for 2022, do you know what the best performing asset class was? It was cash. Cash returned about 1.2%. The second best asset class was yours truly, Australian equities. Australian equities returned negative 1.8%. And don't forget, we've got a lot of dividends here, but we are quite a safe economy and we had a lot of big companies that were really keeping us afloat in 2022. Some of the worst performing ones were economies that were the big risers, like the S&P 500, who did amazing during 2020, 2021, but 2022 was not their year. So if you want a performance chart for asset class returns all the way back to year 2020, it's quite interesting to see what is at the top is normally down the bottom the next year. So it's really important to just recalibrate your portfolio and make sure that you are selling things at profit and then rebuying them when they've come down a little bit. People don't believe in market timing, but it's just about using asset allocation as your friend. In Australia, another builder has gone bust. So in Sydney, a high-end builder has gone bust. I feel like every second article I read now is about a builder going bust. What does that mean for the construction industry? Is there going to be more housing supply coming on, or people and developers just going to stop building because it's costing too much? It's really going to be an interesting time in the property market. Now, emerging markets are a really big theme of ours. We sort of like where this is going. In terms of India, you do need to proceed with caution. So India's inflation has now, again, been above 6% in January. So it's really important to watch inflation and what's happening in those emerging economies because their markets can move quite fast. Still, great theme that we predict over the next 10 years. If you're a bond investor and you want to chase a really, 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 really good return, you can get up to 25% per annum in government bonds. You can get more than that, actually, believe it or not. But these are emerging market government bonds, or emerging market debt, we call that. So that's lending money to a government in an emerging market. So as an example, El Salvador have a 25% per annum government bond. Now, you need to proceed with caution because in countries like South America and Africa, there's a lot of, distress, a lot of issues with government, a lot of turmoil. And what can happen is due to this instability, there can be a lot of that political risk, and therefore you may not even get your return because they might default on their debt. Now, when you are considering this, you also need to take into consideration your currency risk. So it's all good to chase a return, but what's your return net of the currency exchange and currency change? And I'll give you an example. I'll give you an example of Argentina. So Argentina at the moment has a 10-year government bond and the yield is 49.68%. Compared to Australia, it's 3.764%. So dramatically higher. However, 5 years ago, you could get one Argentinian pesos would get you 0.05 cents per US dollar. So 0.05 US dollar. Now it's 0.0052 US dollars. That's an 89% decrease over 5 years due to the currency change. So if you're ever going into this emerging market debt and you're getting lured in, just be careful of one, the exchange rate risk. And if you are going into it, can you hedge your bets? Can you hedge your currency risk? And number two, How actually stable is that investment? As we keep looking around, let me just give you some indications and an update from Morningstar on how to build an income portfolio. They gave a few great little tips. If you are an investor and you want an income portfolio, that passive income is what a lot of people chase in retirement. So they've got some really great pointers. So step one, balance the dividend growth and current yield. So look at current yield, but make sure the company is growing and will continue to grow the dividends that's being paid. Number two, compound your income growth. So what does that mean? If you can, reinvest your earnings. So reinvest your dividends back into the companies, get more dividends over time. So you hold more shares, and that means you get more dividends. And number three, determine the source of income growth in your portfolio. So find what's working, double down. Try and chase a high income return, and eventually all will work out. You can do this with your personal portfolio, with your super portfolio. Number four, step four is reap the fruits of your labor. So if you've got goals and you want to use your income, use your income. If you don't have any need for it, just keep reinvesting. So that's a little bit of information from me for the 14th of February. Thank you for listening. Go off and have a great Tuesday, and we'll see you tomorrow. Cheers.